Okay, so for you listening in Kenya, you know that common advice, build wealth through stocks and bonds.
Yeah, the standard playbook.
Well, it might actually be steering you a bit wrong.
That's a really critical point we need to unpack because, what works well in, say, the US or Europe,
Hmm.
it doesn't always map perfectly onto the Kenyan reality.
Exactly. So today we're doing a deep dive into why that typical Western investment model,
Mm.
well, it might not be the fastest or surest path to, real prosperity for Kenyans.
hmm We're looking at insights, really, from a Kenyan viewpoint,
Hmm.
one that sort of challenges that conventional wisdom about getting ahead financially.
Yeah, so our mission today is pretty clear. Let's try and understand why here in Kenya, focusing on generating income actively,
Yeah.
building your own businesses, why that might be a much more direct route to wealth compared to just relying mainly on the stock market or bonds.
Okay, let's get into it.
Right. So first up, this common advice, you hear it all the time, don't you? Stocks and bonds, that's the key to getting wealthy.
Oh, absolutely. It's everywhere in the global financial conversation, often pushed as the foundation of smart financial planning.
Precisely. But okay, let's ground this in Kenya. The Nairobi Securities Exchange, the NSE. Look, it definitely has some strong performers. You mentioned Safaricom before we started recording.
Safaritom's a great example, yeah.
Yeah.
A real powerhouse. Some investors have seen fantastic growth there, no doubt.
But, and this is a big but, isn't it? For many individual investors outside maybe those huge success stories, the experience can be quite different.
That's right. A lot of people investing on the NSE might see their money just sit there
Right.
or even go down. It's definitely not an automatic win.
So it's not quite the straightforward wealth generator people might imagine.
Not necessarily, no. And there are factors like market liquidity, how easily you can buy or sell shares, and the volatility of the price swings.
Right.
These can be quite different from more, let's say, mature markets.
Okay. Then you've got the other side, the supposedly safer options, like Kenyan treasury bonds.
Right.
They advertise returns, maybe 9%, sometimes up to 13% per year. Sounds pretty good on the surface.
It does initially. Very appealing. But, and this is crucial, you absolutely have to think about inflation and taxes.
Uh-huh.
Once you account for those, that real return, what you're actually gaining in purchasing power, well, it often drops quite a bit, maybe down to something like 4%.
4%. Okay. So this brings up a really important question for you listening, right? If you're trying to genuinely build wealth, maybe starting from scratch or with not much, is a real return of, say, 4% truly wealth building?
Or is it more about just trying to keep the money you already have from, well, losing
Leaving.
value, capital preservation, essentially?
Exactly. Is it moving you forward significantly or just treading water?
For someone with big goals, starting with limited capital, that kind of return, well, it might just not cut it. Not for building significant wealth in a reasonable time. It really forces you to ask, what really drives wealth creation here?
Which leads us nicely into this whole idea of the hustle economy. Because it really seems like in Kenya, wealth often isn't built by just passively parking money somewhere.
No, it's much more active, much more entrepreneurial.
Yeah, the driving force seems to be people's own initiative, right?
Yeah,
Spotting an opportunity, generating income directly through their own efforts.
precisely. You see it everywhere.
Take real estate. Someone buying and selling plots, maybe in areas that are growing fast, like Kitengela or Juja.
Yeah, that's a classic example. Buying land, maybe adding some value, finding a buyer. That's active income generation. It
Yeah.
requires skill, spotting the opportunity.
Uh-huh. Or think about smaller businesses. Someone running a really efficient mama fua service, doing laundry for people.
Oh.
Or a busy car wash.
These might seem small scale, but a well-run one can generate good, consistent income. Income you can then reinvest.
Right. It's about providing a service people need.
And these businesses, often born from necessity, maybe a bit of ingenuity,
Mm-hmm.
they're really the backbone, aren't they?
Absolutely. And it's not just traditional stuff anymore, is it? Think about online work.
Oh, huge growth there.
Transcription, digital marketing, people creating content on YouTube. Kenyans are definitely tapping into that global digital space to earn.
Yeah, the internet's opened up so many doors, lets people use their skills, reach a wider audience, often without needing massive startup cash.
Then you've got those sort of middleman roles, people involved in logistics, or maybe they understand how to supply tenders to county governments.
Right, navigating those systems, that takes know-how, connections maybe. It's another important way people generate active income.
So when you look at all these different examples, This pattern seems to emerge, doesn't it? You earn money through your hustle.
Step one. Yeah.
Then you take that money, you reinvest it back into whatever you're doing.
To improve it, make it bigger.
And then you scale it up. That feels like the core Kenyan formula for really growing financially.
I think that captures it well. It's about active participation, constantly refining, and strategically using your earnings to expand. It's not passive.
Now, let's zoom out a bit, because when you compare this to, say, Western financial landscapes, you start seeing some pretty big differences.
Definitely. Foundational differences in the ecosystems.
Like income stability. In many Western countries, it's more common for a larger chunk of the population to have relatively stable, predictable paychecks.
And that stability, well, it makes long-term financial planning much easier, doesn't it? You can more reliably set aside money for savings, for investments, month after month.
Yeah, and they often have these really established retirement infrastructures, things like 401ks in the U.S., where employers often contribute to.
Right. Those systems create a sort of built-in savings mechanism, often with tax benefits, employer matches, that really turbocharges retirement savings over decades.
Plus, their stock markets are generally, more mature, more trading volume, easier access for the average person, perhaps.
Generally, yes. More maturity often means more liquidity. Easier to buy and sell when you want maybe a wider range of things to invest in, potentially lower costs sometimes, makes it more attractive.
Okay, now let's contrast that sharply with the specific hurdles many Kenyans face. Income irregularity. That's a massive one, isn't it?
Huge. You might have a fantastic month, then maybe a couple of really lean ones. That volatility, it makes consistent saving and investing really, really tough.
Yeah, how do you commit a fixed amount each month when you don't know what's coming in? I hear that all the time.
It's a very common reality. Good months, lean months, makes long-term investment planning tricky.
And we touched on pensions earlier. For a large part of the population here, formal pension plans might be minimal or just non-existent.
Exactly. So the burden falls much more heavily on the individual to build their own financial safety net, often starting from a less stable base.
There can also sometimes be maybe a lower level of trust in some financial institutions, which might make people hesitant about locking money away long term.
Yeah, past experiences, perceptions of risk, they definitely play a role in people's decisions about where they put their money. Understandably so.
And then, the big one we mentioned, inflation. That quote was brilliant. Eats savings like termites on dry timber.
It's such a vivid image and so true. When inflation is high, it just constantly erodes the value of your money. It makes holding cash or low-yield investments feel like you're going backwards.
Definitely. It drastically changes the calculation for long-term low-return strategies.
Hugely. High inflation really discourages saving in traditional ways and pushes people towards things that might keep pace or beat it, like active business ventures or certain types of assets.
So when you put all these pieces together,
Yeah,
you see this fundamental difference in the time horizon, maybe.
I think so, yeah.
Like long-term compounding over decades might work well for someone in the West with a stable job and pension plan.
A clear, decades-long runway.
But for many Kenyans, there's maybe a feeling of playing financial catch-up, a need to see more tangible results perhaps sooner rather than later.
Exactly. That pressure for more immediate progress often means a more active, maybe shorter-term focus makes more sense for building that initial wealth.
Okay, so we've kind of laid out why the standard advice might not be the perfect fit. But let's be super clear. We're not saying stocks and bonds are useless in Kenya, are we?
Oh, absolutely not.
Yeah.
They definitely still have a role, a strategic one.
In that role, based on everything we've discussed, seems to be more about protection and preservation of wealth
Yes.
after you've already built it through those more active income-generating hustles.
That's the key distinction, I think. They're great tools for safeguarding and maybe growing capital you've already accumulated,
Yeah.
but maybe not the primary engine for creating that capital in the first place for many people here.
I like the analogy you used earlier, building a house. You don't start by putting up burglar bars, right?
Uh-huh. No. You need the walls first. You need the structure.
Exactly. You build the solid house, the wealth from your business, your hustle. Then you install the security systems, the burglar bars, the bonds, the MMFs to protect it.
It's a really good way to think about it. Build first, then protect.
So if we were to try and sketch out a revised order, like a more Kenyan-centric sequence for building wealth, what would that look like?
Okay. Well, based on this discussion, maybe step one is start something. Start a hustle. Any viable way you can generate income, even if it seems small at first.
Right. Get them going. Then, step two, Focus on making that cash flow consistent.
Yes, establish that reliable stream of income. That's the fuel.
Step 3, reinvest. Take that income, plow it back in. Innovate, expand, make your operation better or bigger.
Absolutely. Continuous improvement, scaling up, that's how you build momentum.
And then only then, really, step 4. Once you've built up some surplus, some actual wealth, then you start strategically putting that into protective instruments, things like treasury bonds, maybe money market funds to keep it safe and let it grow steadily.
Precisely. It flips the usual advice, doesn't it? It prioritizes active wealth creation first, and then uses those traditional investments for security and gradual growth later.
So, for you listening, what's the takeaway here? If you're sitting there wondering, okay, where do I even start?
Well, the message seems to be, look inwards first. Look at your skills.
Yeah, what are you good at? What service can you offer? Is there a problem you see that you could solve for people? That's where the real potential often lies.
Maybe shift your primary focus away from just thinking about which stock to buy, at least initially.
Yeah.
Prioritize creating actual value yourself.
Get away from maybe the hype around investment products being the magic bullet.
Yeah, the get-rich-quick through passive investing idea. It's often more about producing something, building something tangible first.
Start producing, build something, then protect it.
Because really, in the Kenyan context, true prosperity, it often doesn't come just from buying a tiny piece of someone else's big company. It comes from being the valuable entity yourself.
That's powerful. It comes from being the stock. You are the value.
Exactly. Your ability to generate income, your skills, your venture, that's your primary asset.
So maybe the final thought to leave you with is this. How can you actively work on developing your own stock? Your skills, your knowledge, your earning power right here, right now in the Kenyan economy.
Because focusing on that, that's probably where you'll find the most significant returns on your effort. Build yourself first.